Welcome out to the Trading Justice Podcast, number 584. Paying attention, navigating overextension. Going to talk a little bit about P.A.Y, concept that we wrote about in the Tackle Trading newsletter, or I should say my brother, Matt, who happens to be here alongside this podcast, wrote about. How are you doing, Matt? How's the AI guy doing today?
Doing good. Excited to be here for another edition of the podcast, and ready to get this market dialed in.
Yeah, no, and an AI guy. I would make that joke at some point in the podcast because I do consider you like the smartest guy I know when it comes to markets and AI and how they. But gonna make it right off the bat because we have an AI webinar coming up this week, a special event in which Matt will be teaching. It's going to be free for all. AI Gold Rush, Matt. I could try to describe it, or I could be lazy and let the guy who's going to be teaching do a better job describing it.
I do a webinar called the AI Gold Rush. It has a PDF that people can download for free when they attend the webinar. I've done it a few different times. I did a very detailed, extended version of the AI conversation multiple different times in our Tackle Trading Pro membership in the Coaches Show. But we're going to do it for YouTube this Wednesday, June 26th at 8:30 p.m. Eastern Standard Time. I'll be live on YouTube talking about the AI marketplace, going through what is the AI marketplace, what is the direct impact, the indirect impacts. We're going to be talking about the different aspects of the AI marketplace. We're going to go through the projections from a revenue perspective, because I think it's extremely important when you're when you have an opinion of something in the market and you have a strong opinion of something in the market, you got to have a belief in the long-term projections of that specific area of the market. Whether you're talking a couple of years ago when we were so aggressive on the energy catch-up with crude oil, and that was one of the best trends we've ever seen in the market, quite frankly, a very consistent trend. But we were confident on that trend, and we were willing to hold against downward pressure in price or consolidation in certain timeframes, because you had a belief in the argument for the growth aspect of it. And when you have that data that supports your opinion, you have a lot more confidence than if you're just willy-dilly, throwing money against some stock out there in the short term. And so having an understanding based on the data that you're projecting from a revenue perspective is extremely important. And I'm going to go through the projections, for 2030, the next 6 years, of what we can expect from a growth perspective. And I feel it's quite impressive. And quite frankly, over the last 18 months, Mark, have you ever seen me come off this AI conversation?
No, you've been very consistent.
In fact,
you've kept me grounded on it
along the way. I was pretty bullish 18 months ago when NVIDIA kind of started this entire conversation. It's been nothing but more and more and more since then. And I kind of feel that's going to be the case over the next 6 years as well. And so we're going to go through that. And then at the end, we're going to update that tier watch list. I break them down into 3 tiers: tier 1, tier 2, tier 3. Tier 1 are the direct companies that are building out the AI development. They have a direct impact. Think NVIDIA, for example, the developer of the GPUs. Think Taiwan Semiconductor, the developers of the actual chips. Tier 2 are software components, that companies that develop AI software solutions. And then tier 3 are those up and coming growth opportunities, smaller companies. But if you want to have an understanding, a complete understanding, and that's the difference between Tackle Trading and every single other educational company out there, every other newsletter company out there, every other market, commentary company out there, every other, stock market coaching company out there. What separates us is we not only try to give great analysis, we also try to educate along the way as well, so that our community has a complete understanding of the situation, instead of just a quote unquote hot tip out there. So we're going to have a lot of fun on the AI Gold Rush webinar this Wednesday, June 26th, 8:30 p.m. Eastern Standard Time on our YouTube channel. So definitely check it out. Definitely come join us. You're going to learn a tremendous amount. You're going to get excited about the AI marketplace, and you're going to have a deeper understanding of the number one reason, the number one industry, the number one sector, the number one everything of why we're talking about a market at an all-time high, why we're talking about a market in a growth area of the market, despite the economy not doing great, despite inflation ripping into consumers, the market is still at an all-time high. And a lot of people wonder why. This is the reason. This is the why to why the market is at that all-time high. And so come join me June 26th, 8:30 p.m. Eastern Standard Time. We're going to have a lot of fun in the AI Gold Rush webinar.
Yeah, no, and two things here. One, this is why I call you the AI guy, is because of that differentiation that between us and other analysis, and quite frankly, between you and other individuals analyzing it. It's just a different level of depth, and it ties into the markets itself. And the second thing, Matt, I love when you find a theme or a narrative or a macro driving force, like you referenced oil a couple years ago, like we've had gold for, I don't know, a decade, and what we'll probably have with AI for a decade, because they don't provide just a trade.
Yeah.
They provide a series of constant trades and opportunities along the way. They don't come around every day, do they?
Yeah, and I'm glad you mentioned gold, because I called it the AI gold rush, and I called it that for a specific reason. I wanted gold in there for a couple different reasons. Number one, I do see the development over the next 10 years as a gold rush. I do. I see everybody in the world getting excited about this. The development is unreal. The projections are unreal. It's an amazing area of the market to truly understand. But I also called it the AI gold rush because if you look at any asset class in the marketplace, and I've never really went into detail why I called it the AI gold rush, Mark. So just give me a second to kind of explain this. But I called it the AI gold rush for a couple different reasons. But the number one reason I called it the AI gold rush is because there's two asset classes that I have the most confidence on over the next 5 to 6 years. And it's gold and it's AI. And it's those two spaces of the market. And why is it those two spaces? Because the underlying arguments for both of those two has never had a historical comparison in terms of what transpired throughout history versus what is going on right now. You want to talk about gold, you talk about the 1970s, and you talk about the 1970s from the stagflation perspective, and that's certainly a proper case study when you're talking about gold. However, Mark, in the 1970s, you were talking about the beginning point of the fiat currency crisis. In 2024, when we're talking about gold, we're talking about the conclusion of the fiat currency situation, going into that phase 3 of the currency cycle. And so in terms of there's a lot of confidence in gold ownership because of the underlying belief in what creates or in why you want to own gold in the first place. The debt explosions from around the world, the stagflationary arguments, the inflationary arguments, the protection strategies, and the ultimate conclusion of the safe haven against currency risk out there. Those arguments, we don't need to make them all the time, because once you have that belief, it never changes. And so if gold goes through a little bit of volatility, we don't care. We don't care.
You don't care, right?
You don't, because you don't care what happens.
It changes how you manage your portfolio.
Meaning you don't microanalyze.
You don't microanalyze it.
You don't micromanage it.
What does this candlestick mean, right? Like
I don't care on
care.
any one day in gold. That's why I say constantly, if it's another day that ends in Y and you don't have a max position in gold, this is a good day to start acquiring that. I have a similar feeling about AI, and it's not the same as gold, as the gold argument that is so well documented from a historical perspective, an economic perspective, and I can go on and on and on about that gold argument. But the AI argument is one of comparison of the tech build out in 1994, 1995, throughout 1999. And right now in that argument, Mark, the AI development is going to dwarf what happened in tech. In my estimation, it's that next evolution. And if we think about the tech impact on our lives over the last 24 years and the amount of money and capital and revenue that these companies have generated over the last 24 years, it's unprecedented in human history. And I actually think
Matt,
AI has the ability to do more than that.
it is being taught the build out, right? The build out. It's a massive, and it's transcending just market talk. I mean, President Trump was in a little roundtable with some of the tech individuals and did all the thing, and they brought up, like energy and the amount of energy it's going to be required to build out for AI.
Mhm.
And then Trump said, "I'm fine with nuclear," which is like cool. Right?
Nuclear
Cool.
might be a little bit more of a conversation as we navigate the future.
But I mean, but this build out is real, and you're going to talk more about it on the webinar.
Listen, if we don't stop talking about
I was going to say, if we don't stop talking about it,
I will say one last point, and I think it's extremely important. There's a difference in terms of what I'm going to be talking about on Wednesday versus what you just talked about.
Mm-hmm.
I'm going to be talking about the direct impact of AI. What you just referenced is the indirect efficiency arguments of AI. And
dude, you're AI guy. I got to find a spot in this food chain.
And the secondary impact in the infrastructure development to accomplish AI development. You have NVIDIA, Taiwan Semiconductor leading the charge. But those are technology companies building out AI, building out the technology, building out the software components. You're talking about the secondary impact of infrastructure, and that's an indirect impact. And I think the indirect impact for the financial markets are, I don't think you could properly project a number on the indirect impact because it's going to dwarf whatever anybody thinks, including myself.
Needless to say, freaking attend the upcoming webinar. Links there. It's going to be fun. You're going to learn a lot.
It's just a fun conversation to understand, right?
It's just
a fun conversation to understand.
It's an important, and it's a big one, right? Anyways, we got to shut up. We got to put a stop.
I will tell you, I don't get into the whole pros and cons of AI from a ethical, moral.
AI is like the new Fed for Matt. Whenever I used to bring up the Fed, if I ever wanted to get Matt going on a 15-minute rant because I didn't feel like talking, I would bring up the Fed. Listen, now it's like AI. If I get him talking, he'll talk for like 45 minutes straight.
There's a couple topics that when we have those conversations, I feel I have a tendency to interrupt a little bit more.
It's just natural excitement. You're like a little boy. Like, this is exciting, right?
I got some things I want to talk about, Chucky.
You got some things you want to talk about. Listen, I want to talk about, Matt, this market, as we get into our normally scheduled programming, this market for me is much easier to understand when you segment it, right? Because there's tech, there's semiconductors, there's some hot stuff, there's other stuff we referenced, and we talked about this in our stabilization argument that we'll touch and build upon here in a little bit. But by segmenting the different areas of the market, I find it much easier to navigate. And in the newsletter this weekend, the Tackle Trading world famous Reason to Be a Pro member newsletter,
you read this weekend.
It was a really good read. We did segment out, even without intending, because that's just where the natural conversation flows of importance. And let's start. We're going to get to everything else in a little bit, but I want to start with tech, and then I want to get into semiconductors. Mm-hmm. There's been a lot of excitement. Tech's taken a surge. And when you get in, especially in modern markets, everything are so fast, you have a tendency to shoot and move fast, right? These markets don't wait around when they decide to make a move. And, as a technician, as a trader, we're trying to find ways to logically rule-based navigated situations that really go really, really fast. Talk about this concept. Talk about what you wrote in the newsletter. I found it fascinating.
Well, in terms of the marketplace itself, as of right now, in terms of the ES, we talked about this last week in the podcast. I detailed it in the newsletter last week, the divergent behavior between the exact same market index, the RSP versus the SPY, one weighted, one non-weighted. And when you see that degree of divergence, we're not having necessarily a stock market index conversation. We're having a sector conversation, and specifically a technology sector conversation. And so when you do see these divergent scenarios where you have pretty aggressive separation from a sector perspective, and specifically that one sector in technology, because it's only technology that can create a divergence between
Yes,
the RSI.
theoretically, any area of the market,
no other market could do.
But 99.99999% of the time, this is going to be a tech that creates it.
Yeah, well, it's because of how much weight tech has in the S&P in general, right? We're talking 11 sectors, and tech has 28% of the entire space. And so when you're looking at the marketplace right now, I do see it as that general divergence. Now, the base case we talked about last week was the tech, riding AI, riding that growth area of the market that's really showing the current momentum, and treating it from a pure technical perspective, which means, and if that's the case, and tech's going to lead here, and I certainly still think tech's going to lead here, but as tech gets overextended in the short term, that money flows, because we are in a bull market, Mark. That money flows from the tech through profit taking into some of the other areas of the market, which creates a little bit of stabilization. And so that's kind of the base argument, is firmly entrenched in some degree of slightly bullish condition right now. The S&P 500, when you're looking at it from a pure multiple time frame perspective, the short-term trend is bullish, the intermediate trend is bullish, and the primary trend is bullish. You're talking bullish on every single time frame. Now, obviously, based on the conversation we had last week, that doesn't mean everything in the market is bullish, but the market itself, from a pure technical perspective, certainly is on every single time frame. Now, what's important in these moments, if you're going to look at it from a technical perspective, because until those themes change, Mark, you got to look at this from a pure technical perspective. And I just don't think those themes are going to change in the market until you get catalysts that change those themes. And we're probably not going to get anything between now and the kickstart of next earnings season, which is just a few weeks away. I think the banks start to report in about 2 to 3 weeks. And then you obviously get a very lax first week in earnings season. And so you got a little bit of time between now and then. And so you do see this as a technical situation in the market. And so when you're looking at the S&P 500, as the S&P gets overextended a little bit, typically what you're also going to see is technology get overextended in that environment as well. And as technology gets overextended, what you'll start to see in the short term, from just a typical technical analysis perspective, is something gets overextended, is they start to roll over, because it's harder to find all the buyers at the top price versus at the low price. And so as those traders start to lock in profit, tech starts to roll over, creates momentum patterns, flag-based patterns, high-based patterns. Little bit of consolidation goes a long way here when you're overextended. But where does that money rotate into? In a bear market, in a market that's concerning, it might just rotate into cash. But what we've been seeing is that $5-6 trillion in money market accounts is being put to work this year. And so I doubt they're going to be going to cash, quite frankly, when you're talking about a bullish market. And so in terms of that rotation, you typically will see rotation from technology. Obviously, the leadership in the market is creating the overextended situation. That money will flow into different areas of the market in the short term, not in the long term. This is more just simple technical analysis, as rotating, as one is at resistance and the other ones are at support type thing. And so you do see that. You don't see, as we head into next week, you don't see the themes changing at all from last week to this week. Yeah, tech had a good week. Obviously, it was right there in the middle of the pack, but that's only because Apple and Nvidia sold off on Friday against momentum bullish uptrends. And so it wasn't necessarily overperforming this week, but again, you still see this as that is the theme playing out in the market. It's just overextended right now. So you would need to see secondary patterns in technology, secondary patterns in semiconductors, which could happen very quickly. We're seeing snapback pullbacks on NVIDIA, snapback pullbacks on ARM. ARM actually made the traders report. So if you're a pro member, definitely check out that prep work on ARM. We had an awesome trade just about a month ago. This is that second trade. So playing with a little bit of casinos money there on ARM. But again, these patterns don't take a long time to develop at the top. So that's how I kind of see it. Now, the question and kind of what I wanted to talk about from because we like to educate, Mark. We don't turn
well, yeah,
on
and leading into this education, Matt, just from my experience of doing this 15 years working with individuals, one of the toughest ledges to walk a new trader down off of is when price is going up, telling them be patient and wait for your opportunity. We call these secondary patterns that tackle trading. But it's a tough ledge to talk a new trader off of because they see the excitement.
Only new traders, though.
Yeah,
because they're excited to get out there and get that money.
And they see it go up, and they haven't learned the lessons of chasing and patience and waiting yet.
Well,
right?
This is a really good lesson because you'll stop buying when the pros are selling.
It's a very important lesson. So I just wanted to give that little lead into what you were going to talk about here.
Yeah, there's an important moment technically in a trend, Mark. When you're talking about the development of a trend, what you're really talking about is basically the patterns that develop within the backdrop of a trend. And so a trend basically starts out of neutrality, continuation pattern analysis, whatever you want to call it. But a trend starts with what is known as a breakout. When the market breaks out of resistance, that creates the beginning point of a new trend. Now, obviously, we have breakouts within existing trends, but I'm talking about the development of a trend here. And so when you break out of resistance, that's the beginning point of a trend. That would be the first pattern within the existing trend is a breakout. And then as it does get overextended to the top side, that second pattern starts to play out, and we call that pattern number 2 in a trend, and that's when it gets overextended. And when it gets overextended, you want to be patient. You do not want to chase price action because when it gets overextended, you got to realize technicians, and most of the market is based on technicians and technical analysis. And if you ever listen to traders,
Matt,
technical analysis
more than ever.
I'm sorry. It's not even an argument we should even bring up. It's not a debate.
Matt,
it's not a debate in the market. Algorithms control 90% of the price action period.
Matt, so I've been doing this, oh my goodness, about 17 years now. You've been doing it about 20. And I remember in consuming information when I first, because I consume data in, figure out. I would run across material all the time, scoffing at technical analysis, and I'm talking financial media, financial education type stuff, scoffing at it, mostly because they didn't understand.
Yeah.
If you made that argument today, you'd be laughed out of the room.
You should be laughed out of the room
because of the dominant role that algos
explain the algorithms without talking about technical analysis.
You can't.
They're programmed based on price action. That's what technical analysis is. It's based on price action. So you just can't do it. And I don't listen to those arguments anymore. That's just
there's fewer of them. There's fewer of them.
Well, yeah, because that's traders who can't read a chart, and a trader who can't read a chart typically isn't a trader for very long. Yeah. And so in terms of the 3 patterns here, the first pattern that establishes the trend is a breakout. The second pattern that happens within the existing trend is an overextended. And once it gets overextended, you want to stop the buying. It doesn't mean you short because you never want to short against the existing trend, but you stop the buying. And much like the marketplace, you go focus on some other aspect of the market because we got 11 sectors, 110 industry groups, thousands of stocks out there, commodities, currencies, crypto. You got an entire market. There's something else setting up out there. Switch it, go to a different space, kind of like, what I was talking about in the newsletter. I kind of like the energy development right now coming from the low point. Doesn't mean I like energy more than tech. It just means that tech's overextended and energy is the lowest valued area of the market sitting at the 200-day moving average. That's a different conversation. And so when the area of the market or the market itself gets overextended, oftentimes you'll see either simple consolidation as the market stops buying and stops doing anything, or two, you'll see that eventual pullback retracement where it basically resets the pattern. And so either one, a high base or a retracement, will reset that pattern within the trend. And so when you're looking at this concept of understanding overextension, I think it's extremely important because you can look at it in different ways. For example, if I'm looking at a breakout mark and I'm 3 days after the breakout, I kind of feel like you missed it, which means establish a rule that says if you're 3 candles after a breakout, you can't make a trade.
And Matt, and I think, and this is what, if I have you as the listener take in one thing, is the establishment of rules in these situations. And Matt's has dropped, will continue to drop little hints along those lines. Because, Matt, when you're 3 days into a breakout, the emotion and the excitement is there, you know.
Oh, and the moment, and think about it, Mark. The very day of the breakout, not a lot of people are familiar with it, right? The second day, a lot more people are familiar with it. The third day, you're behind everybody else.
Yeah,
you're behind the pros. You're behind the algorithms. You're late. Period. End of sentence.
which is fine. I've been late 9 million times.
A breakout in the first 2 days of a breakout, it's because you weren't paying attention. And if you're not paying attention, then you got to move on to something else. You can't force your willpower there. And so it is a difficult conversation, but it's easier when you can understand potential average yield. And there's some indicators out there that obviously help us understand overextension, like when RSI is above 70. But Mark, RSI can live above 70 within multiple different patterns in the exact same trend. Like you could see RSI stay above 70 for 4 straight.
Not a great contrarian indicator.
Different patterns there.
Yeah, it's not a great contrarian indicator.
But what is a very accurate one is simply understanding price, because price is based on the behaviorals of the traders that create the price. And when you're talking about those traders and kind of how the analogy I like to give in these environments, and I did talk about it in the newsletter, is think about, you know, breakouts, think about waves in the market like a runner running a race. Okay. So the market runs from support to resistance, right? In a bullish uptrend, and it runs from resistance to support in a bearish downtrend. So in a bullish uptrend, from support to resistance is the race they're running. Now, the trend is like a long distance runner, Mark. The trend is like a marathon runner. They can run 1 mile, 2 miles, 3 miles, 4 miles, 5 miles, 10 miles, 20 miles, 26.2 miles, really kind of with that same pace, correct?
Yes, correct.
Okay. And so they don't really change their pace. That's the trend of an area of the market. It's that long distance runner. We really don't get too caught up in the overextension, potential average yield. We're just talking about the trend itself. But the patterns within a trend and the waves within a trend, for example, motive wave up, corrective wave down, motive wave up, that's 3 patterns within one trend. And so in the patterns that develop within a trend, they're not like a marathon runner. They're like they're Usain Bolt, Mark. They're running the 100-yard dash as fast as they can. And Mark, when you're running as fast as you can, you don't have the stamina to go 26.2 miles. You get tired.
This is a fantastic analogy. Continue.
You get tired. And as you get tired, you take a break, you catch your breath, you get a glass of water, and then you can run again. And so in terms of the patterns within a trend, think about them like a 100-yard dash race. It's a race. When you're talking about the trend and the patterns that develop within a trend, the existing long-term trend, that's more like a marathon. And so when you're a runner, Mark, for example, Mark, if you were to get up right now, this very second,
I don't like where this is going. I don't like where this is. I will.
Okay. and you went out and you said, you know what, Matt, I'm going to get in shape today. I'm gonna start losing some weight. I'm gonna start eating right. I'm gonna exercise. I'm gonna live life right. Right. And I'd be like, yeah, let's go do it, bro. And you said, I'm gonna go run a mile. And I said, I'm gonna go run a mile as well. And you and I went out right now in that hot sun. It is hot outside.
It is
right
hot
now.
out there.
Okay. And we ran a mile. Could we run the next mile at the exact same pace?
Not a well, dude. First of all,
I
I ain't finishing that first mile. Let's be honest. I ain't finishing that first mile. So no.
And after you finish that mile, and I said, you know, Mark, we're gonna go run another mile right now. What would you say?
I'd be like, I'm going to the bar, dude.
Okay, so you're gonna take a break, right?
Yes, I'm gonna do it.
Guys, traders, investors are those marathon runners. They don't get tired. They don't. Traders, it's a race. It's a race from support to resistance. And the traders do get tired. The price gets tired. They run out of gasoline. And just like you run out of gasoline running that mile mark, the traders run out of gasoline because the gasoline is the buyers, and there's not an infinite amount of buyers out there. And so as the buyers, because that first day of the breakout, a lot of the buyers are already there, right? Second day of the breakout, a lot of the buyers are already there, right? The third day of the breakout, are buyers like me there? No.
They start to head to the bar, dude.
Yeah, that breaks rules. And so what about, and do you think I'm the only trader with those types of rules, or was I trained with those types of rules? I was trained with those types of rules. Those are hard and fast rules out there. And so
you were trained formally and sometimes by the School of Hard Knocks.
Oh, they both were.
Who is a very fantastic trainer.
They both play. And so what I feel is the most accurate way to target within a trend is not Fibonacci, although I do use Fibonacci, not RSI, because yes, I use RSI all the time. It's one of my favorite indicators, but it's in my estimation, it doesn't give me the behavioral aspect of the technical conversation the same way potential average yield does. And so what potential average yield is it's us understanding how far Mark can run. That's it. So Mark, and it's not difficult. It really isn't. Mark, if you went out and ran a mile today, and you told me tomorrow I'm going to go run another mile, I would say, yeah, I think Mark's going to be able to accomplish running a mile. But if Mark came out,
very optimistic soul.
Okay, I am. But if you came out to me and said, I'm optimistic, but I'm also a realist, because if you came out to me and said, Matt, I ran a mile today and I'm going to just jack it up and I'm going to run 5 miles tomorrow, I'd bet against you. I would short you. I wouldn't think you would finish the 5 miles at that same pace. And so, yeah, could you make it? Could you crawl? Could you roll? Yeah, you could get there, but you're not going to get there in the same pace. That's potential average yield. And just like you get exhausted, just like I get exhausted, so does the marketplace, because the market is based on human behaviors. And so potential average yield, think about it. If one wave moves from support to resistance 5 points and the next one moves 4 points, well, it has a potential average yield of 4.5 points, which means the next pattern that develops, Mark, from that support level to the next resistance level, we would be assessing the market can move 4.5 points. So not only does potential average yield help us understand where something is going to go in the future, meaning it's a wonderful, wonderful targeting technique, but it also helps us understand and evaluate when something gets overextended. So it kind of helps us understand, well, I gotta tap on the brakes. I gotta wait for that secondary pattern. And so I'm going to give you a couple examples here, and then we're going to talk about it from a market perspective. Let's look at, let's say, let's go with a technology stock. Let's go with Microsoft here. Okay. So Microsoft here. Now, we have Microsoft on the report for a breakout, because what we're seeing on Microsoft right now is a high base pattern that could consolidate for 2 or 3 more days, because we're actually overextended. We're not looking for a pullback analysis here. We're looking for a high base, because that's what's happening. And the reason we're looking at a breakout here following a high base is because we are technically overextended. As you can see, and I'll detail this for the listeners out there, the last two waves in Microsoft went from $390 up to 430. That moved 40 points. And then you went from 410 to 450, and that moved 40 points. And so once it moved 40 points, what did we see? We saw 5 days of consolidation, then a pullback against what the market did. Now, what are we seeing? We're seeing it move up 40 points, and now we're seeing consolidation, because now you're at the top end of the range. And when you're at the top end of the range, you're going to tap on the brakes so that you don't be the last to buy somebody else selling you some profit out there. When you look at Hood out there, a very aggressive stock. But in that very aggressive stock, when I look at the current trend, it goes from right around $16.25 up to about $22. Well, that moves right up there about $5.75. And then it moves from a pivot at 19 up to $24. That moves up another $5. And so it doesn't shock me, Mark, that once Robinhood moved up $5 in this current leg, that you saw a retracement or a high base, because that's the typical journey you do see from a technical perspective. Once you get to that potential average yield, you're going to be sucking out the buyers. And as you suck out the buyers, because they've already bought, they're going to start alleviating that by selling back the positions, the profit that they've had. That creates a profit-taking environment where you see bullish retracements on low volume. And when you're looking at Robinhood, that's exactly what we have. We had it move up on higher volume. We had it move down on lower volume. It got into its potential average yield. It formed a bullish retracement. That's an extremely accurate technical backdrop. And so what we're doing is we're simply trying to assess the differences between support and resistance in the waves within an existing trend. And so when you're looking at technology right now, Mark, the leadership of the market, everything based on over the course of the last couple of weeks has been technology, AI, you name it. Well, technology goes from pivot to pivot, 194 up to about 116. It moves up about 22 points. Then it moves from 210 up to 232. Once again, another 22 points. Is this shocking to me?
It's amazing how consistent all of these moves were relative to each other.
All right, then let's do it. You might say, well, Matt, that's an individual stock. That's a different conversation. And then you might say, well, Matt, that's technology. It's a unique situation. Well, let's look at the S&P 500 itself. It moves from 500 up to 530, 30 points. It moves from 520 to 550, 30 points before it starts forming a retracement. Wow. That is potential average.
This is why the newsletter is a world-class. It's not just marketing. We're terrible at marketing. The newsletter we put out at Tackle Trading really is a world-class newsletter. It is great for new traders. It's great for individuals that have been around. You need to read it every week. It's worth the price of admission.
And again, the uniqueness about the newsletter is we don't just give analysis. We don't just give picks. We will always educate, because that is who we are at Tackle Trading. We are educators, which means usually our content's longer because we like to give detail in terms of what is actually transpiring. We don't buy into this, oh, you just go get a hot tip in the market and be able to go be successful in the market. That's not how it works. That's not how it works. That's never how it has worked. What has worked over time is education, knowledge. Knowledge is the tiebreaker. So we try to give knowledge in everything we do in terms of what in the content that we provide our community at Tackle Trading. But potential average yield, I'll just tell you a quick story, Mark, how it came to be. There was myself, potential average yield. You'll not learn that technique anywhere, by the way. It was created by my technical analysis mentor, a guy by the name of Jeff Crystal. And Jeff Crystal, myself, and a guy by the name of Noah Davidson were sitting in a ballroom in Salt Lake City, Utah, in 2009. And when me and Noah, we kind of came up in this industry together, the educational industry. Both of us loved trading. Both of us loved technical analysis. We were two peas in a pod in that type of situation. And me and Noah were both students of Jeff. And Jeff was one of the best technicians I've ever known in my
True.
life.
I mean, and true mad scientist. Picture a mad
He's a
scientist.
crazy technician.
Like
Yeah.
seriously, picture a mad scientist in your head. He looks the part, he talks the part, and he has the knowledge of the part.
He does. He's a wonderful, wonderful technician, and he taught me a lot in how to read price action and so on and so forth. And when I was a young trader going through education, I remember being taught how to target. I remember being taught how to understand overextension. And those are all based on traditional methods of indicators, RSI stochastics, MACD, traditional trend lines, traditional Fibonacci elements. And so when I first learned how to trade from a targeting perspective, it was all based on indicators, whether we're talking about the oscillating indicators like MACD, RSI, stochastics, or whether we're talking about some of the other indicators out there, such as the lagging indicators of moving averages, or obviously the wave counting in Elliott wave and Fibonacci's. Those was how I was properly taught how to target, and I still use those techniques today. I don't just use potential average yield, because every stock has different personalities, and it takes on the personalities of the traders that trade that stock. Some potential average yield is a lot more consistent. Other times trend lines are more consistent. I don't think there's an end all be all of wave counting and understanding support and resistance. I think there's a lot of different ways to describe the technical environment. But in terms of this moment in 2009, this was one of the most important moments of my education, because I'm still a student today. But this was one of those points where I just jaw dropped and everything made sense to me, because I'm an analytical, and
Because you're a left brain nerd.
And so basically what Jeff did is he goes, okay, you guys are going to be doing some targeting techniques. And I'm like, all right, me and Noah have done this a billion times. All right. He goes, okay, we're going to go through every stock in the S&P 500. I'm like, all right, let's do it. And Jeff starts going through all these different stocks. And Jeff hasn't taught me and Noah a thing. He just basically said, you guys target. Where would you target? Where would you target? Where would you target? And so we started doing that. And Jeff is like going through these charts way fast. And like, I've been a trader for 3 years at the time, but at the same time, it was like way fast. I was like, you're a crazy person up there. I don't know what.
He's a mad scientist, legend.
And he's just boom, 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 boom. And he's doing some rapid fire type techniques. And at the end of it, me and Noah just kind of gave up. We're not even really kind of talking at all. And all of a sudden, Jeff's like, all right, let me tell you what my thesis and my theory is. And he laid out potential average yield. And I don't believe there's any original idea, Mark. I do not believe that. And if anything has taught me, if social media has taught me one thing in the last couple of days, there is zero original thought out there. Zero original thought out there. So I don't buy into the, oh my goodness, like even myself, when I have these ideas and I have these, I'm like, I'm sure somebody else has thought about this, but there's different ways to describe it. There's different ways to apply it. There's different ways to execute it. And Jeff laid out potential average yield. And Mark, it's not the pure technical analysis that I have faith in, because I can't get there on just the pure technical read. But what potential average yield did for me was that it helped me understand the behavioral aspect of technical analysis. And that is something I did understand. And all of a sudden, it just made sense to me. And I'm hoping that as I had this conversation on potential average yield here, I hope it makes sense to some other people as well, because it adds the context to the why. Why are we seeing consistency out there?
Why does Mark get tired after running a mile or 1.7 miles or 2.3 miles or whatever it is, right?
To run more than a mile. And the same thing happens in the market. So that's what potential average yield is. We call it P.A.Y. Potential average yield is the vertical distance in the waves. And so you can assess this from support to resistance, but it has to be within a trend and it has to be with patterns, which means you have to understand how to basically assess from pivot to pivot. It's not from, and it's not an end all be all. You got to make some modifications every now and then. but you go from pivot to pivot within a trend, from support to resistance. But Mark, it's not a high base of support. It's a pivot of support. The high base has to have a little bit of time to ensure that it was, in fact, a consolidation and not just a 2-3 day, nothing occurred in the market type thing. And so potential average yield is still today, for 15 years after I learned it, it is still, after 15 years in the market, I still do not see a lot of people understanding it, because again, it was just taught by Jeff Crystal to me and Noah, and obviously we've taught it to our communities along the way, because it is truly, in my estimation, the best way to understand overextension is not based on an indicator. It's based on the pure read of price, and that's what potential average yield does.
Fantastic discussion. Listen, if you do not want to sign up for the newsletter, or if you're a pro member, go read the newsletter, opening sections on P.A.Y or potential average yield. Then I got questions for you. If you don't want to do that. Great.
Right, you didn't know these things.
You do, Matt. All right. So, we spent a lot of time on, technology or the overextension. But there's two sides to the market coin these days. We talked a lot about this last week, about the everything else measured by RSP or the Dow or small caps, however you want to look at it. We haven't had some of the worries about overextension. In fact, I got a kick, I think it was Thursday on the halftime report, where you were like, go look at every other chart. They're not overextended.
Just tech that's overextended right now.
And so it is the top shelf liquor, right? Wanting to understand how to play the good stuff, if you will. But Matt, there's a whole other market. We talked about this last week. In fact, not only do you have things kind of just consolidating like RSP, which is in its basic, you have things that have taken a pretty good clip, like energy. And it is fascinating. This is trading. This is markets where we can be discussing how we want to navigate overextended situations in one area of the market, and then be looking at, all right, what are some potential reversal patterns on something that's been beat up? And these are situations we find ourselves as traders all the time. And I think too often traders only focus on whatever is working that day instead of looking at what might be working next week, which is something I think we do very, very well. Talk about
we
energy.
Definitely like to put things on the radar of our community, no doubt about that. We like to make sure that they understand that there are technical patterns that we are tracking for a week from now, a week and a half from now. We like to get those things on our community's radar, because we have conversations that we have conversations today that the rest of the market's going to talk about it in a week from now.
We do that all the time here.
All the time.
Starting to put energy potentially on the radar of our community. Talked about it in the feature segment of the newsletter this week as an example of reversal patterns. Talk about, just the basics. We don't have time to spend as much time as we have on tech. Positioning in tech is higher than positioning in energy.
As of right this very second, yes. It might be different next week.
But, getting these conversations into the works, right, are very, very important.
And I don't think it's just energy, because I don't think energy is going to start trending bullish unless cyclical starts trending a little bit more bullish, which means you'd be talking industrial, you'd be talking basic materials as well. It's just that energy has had a short-term downtrend, and it's sitting at the 200-day moving average, which is typically a big buyer zone. And that's really kind of the first step in reversal analysis, is assessing the catalyst of support and the strength of that support level. And certainly the 200-day moving average fits one of those catalysts of strength. However you want to categorize it, everybody's going to look at that green moving average, the 200 SMA, and if it's not color green, they're doing it wrong. But if they're going to anchor against that, and they're going to wait on the patterns to develop here, because we expect the market to behave differently at the 200-day moving average than it did 3 weeks ago when it just broke support heading down to the 200-day moving average. And so, obviously, one of the scenarios that we talked about last week was the realignment of the market from a trending perspective, because cyclical has been trending differently than aggressive. Would you agree with that?
You're right. I think even if someone just fresh off the boat would know that.
Yes. So the entire market's been kind of trending a little bit differently. Even in cyclical, energy's had a bearish downtrend. Basic materials had wide range neutrality, but a slight fading bearish downtrend. Finance a little bit more, a shorter duration neutrality, but it's still kind of in neutral. They're all doing a little bit of something different out there. And for the market to get realigned, it gets realigned through themes, it gets realigned through pattern development. There's a lot of ways it can get realigned. But again, the base case is that technology leads, but as technology gets overextended, you start to see stabilization. And as you start to see stabilization in cyclical, you start to see them get more realigned. I still expect technology to lead, but I don't, let me put it like this.
Okay, first of all, I
don't expect them to trend differently.
No, and this is what we laid out. And you said the base case. You need to be very specific. That's our base case.
Yeah,
that's when we laid out the foundation of this last week in the podcast, it was basically in the face of 1 million Twitter posts and 1 million articles that I read that was like, oh, the divergence is showing cracks in the market. And we said, no, let's lay this out. And we started to lay the foundation of it's not bearish. It was bullish analysis. It was just like, listen, there's taking turns, there's stabilization. And so when you say the base case, I guarantee a week ago and even today, that's not the market's base case.
No, that's our base case.
They're still bitching and complaining that tech's had the audacity of having a good stretch.
Tech had the audacity to develop AI. Oh,
yeah, so
bad on you, tech. Stop developing things. Well, yeah, Mark, I do think it's the base case for stabilization and cyclical, and basically, as you get stabilization and cyclical, could be some scenarios play out over the next couple of weeks where the markets do get a little bit more realigned. And I'll just paint you a scenario here, Mark. Okay, I'll just paint you one scenario to help you understand what I'm looking at here. Let's take XLK technology, right?
Okay.
We have a general understanding that this thing is overextended, correct?
Mm-hmm.
Okay, let's say hypothetically you get some short-term consolidation at the top end here. Just hypothetically, you could see a pullback here. You could see some consolidation here. Yep. Let's say we get a week of consolidation. Okay, would that shock you, a week of consolidation at the top end here?
It would be. I just looked at those pay charts, dude. It wouldn't shock me at all.
Wouldn't shock you at all, right? Okay, so let's say we get a week of consolidation, and in that week of consolidation, a week later we break out. Okay.
Yep.
All right. Now, in that same time frame, let me look at energy. Okay, energy has been trading completely opposite of what technology has. And so when we're looking at energy, technology has been a bullish uptrend, overextended. We're expecting consolidation. Energy has been a bearish downtrend, sitting at the 200-day moving average. But Mark, over the next week, what could you see? You could start to see this reversal play out. And I don't want to steal the thunder of the newsletter, because I detailed this extensively in the newsletter. But you are seeing reversal situations play out here. It's in the middle of it. I don't want to say something has reversed because we have not gotten confirmation. And in the newsletter, I drew the exact charts you need to see to get that exact confirmation. But what you do have, Mark, for anybody that understands the art of the reversal, is you're at a support catalyst with slowing momentum and trend. That's point one. Point two is you want to see a deeper retracement. That's where we're at. You have slowing momentum and trend. You see this big drop in price followed by a shorter drop in price. When we just covered potential average yield, when something moves 5 points, then it moves 3 points, that's slowing momentum. And so you have slowing momentum at a known catalyst, and then you have a deeper retracement. Well, Mark, you could see a lot of scenarios over the next week and a half a week and a half, 2 weeks, where you see technology consolidate at the top because it's overextended, and to leave that overextended, you do need to see some degree of consolidation. But in that same time frame, Mark, you could see some scenarios where we double bottom on energy. We actually form a V-shaped high base on energy. And so you could see a scenario where week and a half from now, yeah, you're in the consistency of a developed trend within technology, but now they start to trend in the same direction. And that's the market getting a little bit more realigned. And so we're closer to that realignment than you might think. And that's if it plays out to the bull side. If it plays out to the bear side, the realignment will take a little bit more time frame in my estimation, because if we rotate to the bear side, most likely you'll still be in profit taking in tech, versus energy will start to sell, cyclical will start to sell. So that is a different conversation. But I could see some scenarios here where energy starts to go through some reversal situations here. And in those reversal situations, you would see that as a stabilization and improving condition against the backdrop of the bearish downtrend. So energy, it's not there yet. But again, this is what we do. We have conversations to put it on our community's radar, because these are we're starting to see the early signs of reversal situations in energy. In the same time frame, we're seeing overextension in technology.
Yeah, no, and this is like kind of that no harm, no foul analysis where you're like, all right, we could see something develop here. You put it on the radar. If it doesn't develop, it's like, oh, well, we spent a few minutes, but we have a tendency of catching a lot of these. And when you catch a trend early, man, it's so nice.
There's a couple of things we don't like missing, and one of them is we do not like missing a reversal in energy.
And we don't like missing in major areas of the market, whether it's gold or oil energy is one of tech, because guess what? Tech will have a sell-off one day, I promise you. Might not be for a minute, but look,
listen, tech can get violent on the volatility. It's really overextended. It's obviously all eyes are on technology. It could have some volatility here.
No, and one thing I want to, spend some time on next week and, spend a few minutes on right now, Matt, and just give me RSP and then give me the Dow, give me small caps, all these things. And I wrote about this in the economic section of the newsletter. And, I had to call you up last night and I was just like, man, you got to look at this. This is really, really, really cool. But we have broad non-participation, right? Broad non-participation. But one of the things, Matt, that I saw on financial media, social media this week, I saw the economic surprise index. Now I saw a bunch of people put one out from Citi, other used the Bloomberg one, but it seemed to be all the rage, even by smart people like Mohammed El-Arian, like lots of people talking about it. And basically talking about the surprise index, which is a measurement of how economic reports do in totality versus expectations, right? So economists expect A to happen. If the report comes in stronger, well, the surprise index goes up. If it comes in weaker, it goes down. And what you've had over the last, 5-6 weeks is you've had.
By the way, this is not an economic conversation. This is an expectation conversation.
This is an expectation conversation. I'll get to that here in a second. This is like, what do people expect, right? And so over the last 6 weeks, the expected results of economic reports have come in on the light side. Now, anything disastrous? No. Has the totality of the hard data been cataclysmic? Hardly. We're still in a growth mode, maybe stagnating growth, but still in a growth mode. And yet over the last week, I saw so many people on financial social media be like, oh my gosh, look at how weak things are right now. Look at the surprise index, the lowest reading since 2022, right? The lowest reading. The economy is obvious.
The last week of beats.
The what?
They're not going to like the last week of beats. That's not how to start.
And so referencing this, now this, and I wrote about this in the newsletter. And if you want to read this in the newsletter, basically me castigating these individuals and be like, this isn't how you should approach it. What I want to bring up here on the podcast, Matt, is something I find very, very interesting. We look at the participation out there right now, lacking, right? Not the first, but this is not unique over the last 18 months, is it?
No.
We've had lots of stretches where you've had less participation than maybe market breadth enthusiasts would like.
It's a well-known thing over the last 2 years.
It's happened numerous times. Now, the one thing that I found very, very interesting in looking at the surprise index of expectations is that when economic reports fell short in various stretches, not singularly, but enough to create a trend, this lined up with the close to origins of what we would call everything rallies. When you look at January of 2023, the surprise index had fallen to a very low level.
November, December bottomed out.
Last year bottomed out. April 2023, January 2023. These were all after stretches where economic data missed expectations in a consistent enough stretch to create a trend on this expectations index.
Yeah.
The second those started to turn around and beat to the surprise side, they marked broad participation rallies in the market. Small caps, start of 2023, everything, May and June of 2023, obviously the rally last year. And here we are again, right? I think there's some correlation here, Matt. And the funny thing about expectations, and then I want to get your thoughts on this. The funny thing about expectations in these type of reports is they have a self-fulfilling prophecy of turning around.
Yeah, it's teeter-totter.
Because as you miss, what do economists do? They lower their expectations, which kind of puts in a floor of the expectations, and then you start beating. And as you start beating, well, small caps that are cyclical,
expectations.
All of a sudden it creates this, and it has lined up with broad participation rallies over the last 18 months. And here we are at a very low level after trending. Man, it seems like all you'd have to do is get a little string of positive economic beats. We could get some of that broader participation we're looking for.
And again, some people will look at this chart and they'll think, oh my goodness, end of the world. I see this chart and I see markets in turmoil on CNBC being the #1 contrarian.
The contrarian in me loves the contrarian in me looks at this chart, Matt, and I'm like, that's the most bullish.
Knowledge will look at this chart and not understand a lick of what it means.
Matt, some of the people with knowledge should have known better.
And yet they will form very strong opinions on something that they do not understand what this means. This has nothing to do with the economy. Like nothing to do with the economy. This has everything to do with how expectations are set on the reports. And as you get a string of misses, obviously low bar expectations occur. If you get a string of hits, obviously high bar expectations occur. It's a very similar situation as what I talk about all the time on earnings reports, Mark. When you've been front run going into an earnings report, the bar to beat that number is higher. Well, if you've been selling off in front of earnings, it's a little bit easier to overcome that low bar expectations from an earnings perspective. And so a lot of times, a high quality company that will get front run in front of earnings, but it will gap down despite a positive earnings because it front run and, increase those expectations. Same thing happens on the downside here. I see it as a contrarian indicator is what I see this as.
No, absolutely. Absolutely. And Matt, there's also because the funny thing about this is a lot of the negative expectations has been based on survey data, where the hard data, I don't know, industrial productions came in this week and it was actually showed strength. Hard data, PMI numbers came in. Do you think in some of the survey data out there, there is a little bit, and I go back to, I was about a month ago, we talked about it on the podcast. There was that questionnaire poll, are we in a recession? And what was the obscene procession? Is the
Was it
market up?
purchasing managers? Who was in
No. This was the one of average citizens.
Okay, yeah, but
Yeah,
it was like 70%. But again, like these expectations, yeah, it was about 70% thought we were in a recession. Yes.
it was so, and the market was down this year.
Mhm.
Now that was of average individuals, that poll,
Yeah.
right? But do you think there is some of that bleeding over into people that maybe should know better? Like some of the political negativity surrounding 2024?
Oh yeah, of course it does. Some really smart data-driven traders that I know who also, because you and I, we like Mark, I'll tell you right now, the number one thing I'm excited about this week is watching the debate between former President Trump and President Biden. I geek out on those things.
We
I love
geek
those
out
things.
on those things.
I absolutely love those things. I love politics. I wish people could talk about politics more, normal, without hate, and with an understanding that we Americans have 99% commonality against the backdrop of human history. But that's not our political environment. I wish we could. I honestly wish you and I could talk more politics on the Trading Justice podcast.
We would love to talk politics more,
Is
especially as it intersects with the market.
It does. It does quite often. It does. But the fear is that as we, especially for me, Mark, because I'm a data-driven guy, I'm a left-brain guy. I don't get emotional about these things. I don't get opinionated about these things. I just like to have those types of conversations. But a lot of times I feel like those conversations just never do your community good, because somebody's going to be extremely opinionated in those things. And so we just don't do it. But I love politics, love talking politics. I'll tell you right now, Mark, I remember studying, political science history back in college, and you were a big poli-sci history economic guy in college as well. But I remember in political science courses with, Professor Roberts or Dr. Statham, and basically, literally watching the 1960 debate between future President Kennedy and Nixon, and seeing how that impacted that election cycle. And then obviously Reagan's 1984 comment on his age was just absolutely infamous. Dan Quayle in the 1988 vice presidential debate was pretty funny, I would say. Some of Clinton's debates, Clinton was an orator. He was a great debater. But even watching Clinton and Bob Dole back in 1996 was fantastic. The George Bush debates, George W. Bush, by the way, still probably the number one president I'd like to have a beer with, because I just think it would be a really cool conversation. But President Bush, his debates with Obama, not Obama, but McCain and Obama in 2008, and Romney and Obama in 2012, Bush and what was John Kerry? It was John Kerry, wasn't it, in 2004? I love that stuff. I absolutely love that stuff. And so I think the number one event this week is the presidential debate that's going to be occurring on Thursday evening. But Mark, what I have found is that 99% of the population, including Wall Street analysts, have a very difficult time separating the emotion from the political conversation to the data-driven economic conversation. And yes, I do find it oftentimes clouds their judgment. I'll tell you, I don't think you can remove the political bias from anybody. I don't care how analytical left brain nerd you are. But I will tell you right now, I try, and you know this about me probably more than anybody, I don't have a biased opinion of that. I try to call balls and strikes. I try to look at it from a data-driven perspective. And honestly, Mark, I feel like it helps me in my economic projections. And why I feel like I'm a little bit more accurate on projecting the economy is because I do not take into account in any capacity what anybody in America says about politics in regards to the economic conversation. But I do think it does impact a lot of other people.
Yeah, I think it does. And I think economic data reports about the demise of the economy. Now, the economy's not rocking on all cylinders right now, right? And and just from an economic, I mean, GDP forecasts are very, but they're not.
Well, let's face reality, though. They're averaging 1.92% over the next 2 years. Over the last 14 years, that's what we've averaged. So, I mean, there's like, I'm sorry, if you're going to say the economy's not rocking at 2%, you got to say that about the economy over the last 14 years.
My main point, though, is like the direness, and we've seen this off and on in the last couple years, Matt. It's almost like there's this cottage industry of everyone is so afraid of missing the next recessionary call, right? They're so afraid.
All those dudes and gals have made those calls for the last 5 years. They're all over the board. So what? Obviously, we're going to have a next recession. Obviously, we're going to have another bear market. And obviously, the bears are going to come out and be like, I told you so. When the rest of us know, they've been telling us so for 15 years. They have missed out on 15 years of price appreciation. And so, yeah, of course, they're going to come out there and say that. But why listen to bears? They're always wrong.
Yeah, they're not only wrong, but this surprise index, man, I mean, it's a reminder to me. Could there be problems one day? There will. You live long enough, there's going to be problems, right? But you got to be as objective as you can in your analysis and remove and for you, it might be easy. It's not easy for me, and it's not easier for most people to remove as many of those biases as possible.
Why do you think it's not? Because I would agree with that, Mark. It just being, and don't want to get too deep personal here, but I would agree with it that you cannot remove the political bias as much as others. Why do you think that is? Is it just because you're emotional about some of the issues? Like they're and I'm not saying that as a negative, by the way.
No, I think it's just part of my own.
Because you're very passionate about some of those issues, and they mean a tremendous amount to you. So I don't want to make that sound like I'm like, because sometimes I wish I had your passion over single issues. I don't. I see it from a macro perspective, but sometimes I do wish I had that passion over single issues the same way you do. Do you think that's, just looking at you and me, do you think that's kind of the differences between you and me, is you have a little bit more passion around single issues versus me? I kind of see it from a big picture, 64.
Yeah, no, I mean, because you hear about single issue voters, and while I'm not a singular issue
voter,
but there are a
You're
few
an issue
issues
voter, though.
There are a few issues that I feel stronger about than others.
Yeah.
And I certainly think because of the fervent desire to have those issues win in the long term, I think it influences, influences what I want to happen in politics. And let's be honest, bad economic is good for Trump, bad for Biden, right? Like as far as heading in, because heading into this election, which we're just a few months away from, well, if the numbers are bad, well, that's all bad for Biden. And we know this is to be true from, I don't know, every ounce of political history, right? You're incumbent president.
Listen, here's the reality, though. It doesn't matter politically, because Trump's going to say whatever the numbers are, they're bad, and Biden's going to say they're good, regardless of whatever the numbers are. Like that's 2 + 2 right now. That's going to be said so many times over the next 5 months. And it will have nothing to do with the truth of the actual economic data.
But I think that when you get to this survey data, whether it's individual consumer confidence or you get to purchasing manners data,
I think it is one of the things that is playing out here.
I think it is absolutely one of the things playing out. the economy is not even close to as bad as that chart would suggest. Not even close. And so what explains the economic survey misses? And I think politics is playing into it a huge role. Because
I don't think the economy's roaring out there.
It's not roaring, and this I think the final sentence in the newsletter was something.
I don't think the economy's dying the same way others.
Exactly, and there's a huge difference, right? A stagflationary type environment, you're going to approach differently.
Yeah.
You're going to approach differently from an investing trading standpoint than a recessionary environment. And there's different playbooks.
Yeah, and both are bad for consumers, mind you. Stagflation.
Oh, yeah. Well, the consumer's screwed in all of these scenarios.
But I do see the likelihood of a stagflationary environment a little bit higher than a recessionary environment.
Yeah.
Both of them are bad for people. Both of them are bad for people. So we're not talking, good economy versus bad economy. It's far more nuanced, complicated than that.
It is more nuanced than that.
I find these contrarian indicators to be really impactful, honestly.
Okay. Bottom line, if economic beats start coming in, which they will, and you know why they will? Because I know what the economic data is? No. But I know that economists will lower their expectations. And when they lower their expectations, the numbers will start beating, puts in a bottom, you get surges. And if history is a guide here, Matt, that's when you see broad participation. That is when you see more broad participation out there, because that's how the last few have played out as well.
Honestly, from a pattern development, based on what you and I talked about between the cross comparison of the technology, market potential average yield conversation in comparison to what we were talking about with energy, I don't see a rip your face off rally in the market going into the summer season, and certainly not the election season. Which would you define the election season as immediately following the conventions?
This is a question I've actually spent some time thinking about, because I think election season trading is going to be different than everything we've encountered the last 3 years, right? I think it's a different little nuanced playbook. And so I think still loosely start mid-September.
Well, Trump's been running since what? October of 22 was officially. So he will have been running for a couple of years going into the election. So, and Biden's been officially running for a couple months, but obviously running for a year. So them campaigning, presidential elections don't ever, it's almost like they don't have an off season any longer. It's
not like
we start talking about the next one almost immediately after the previous one. But no, I think it's going to be fascinating. So I don't expect a rip your face off rally, Mark, but there could be some very interesting realignment over the next couple of weeks, especially if this city economic surprise index plays out like it has over the last couple of years.
And I have a cash flow brain, and it's 99% cash flow. I see that chart and I'm like, oh my gosh, I haven't liked credit more in small caps and the Dow and things that haven't participated, right? And I think technical patterns align up with that as well.
Do you think that's because it fits your deep value type mentality?
Because the most important thing to me is stabilization.
Yeah.
Right. And stabilization, ARM might go up $27 and make a great trade.
Not stable.
Right? But that's not stable.
That's not stable.
That's not stable.
Simply because it goes up and it's going in your direction does not mean it's stable.
And so those charts are hard for me in what I do, because I like nice, boring, steady cash flow. And so I see this and I see, well, my goodness, how much negativity missed. That's going to turn around, because it's not just this snapshot. You look at these surprise indexes for the last billion years.
Just think about it. Every time CNBC ran markets in turmoil in 2022, we got a nice little.
It was the market bottom. It was the bottom.
It's when everybody's looking at the same thing, all of a sudden it has a tendency to change, because those things have been priced in. Those expectations have to get
And
low.
so for the last couple months, I have been very anti your average stock. And I'm certainly not, not the top, but, not the top ones, but everything else.
Yeah.
Some bottom fishing. I think it's time to go some bottom fishing on some stocks.
Well, that's why I like energy. Is kind of, that's the area of the market I'm looking at bottom fishing. There's a couple real interesting stocks that we'll be talking about over the next little bit. But you know what? This is a great conversation. Really enjoyed it here today. Mark, why don't you go ahead and send us out?
I guess 2 minutes on gold. I know we went gone. Just got to do 2 minutes on gold. Just got to do 2 minutes on gold. I know we went long. I just find it hilarious that every time you've had a strong economic report, gold has sold off. The algorithms have sold off, which happened on Friday, right? Like strong PMI numbers. It shut up the economic surprise index people on Twitter for a day.
Those were some good PMI numbers that came out on Friday. The surprise index went up last week because you had more beats than misses. But on gold, quickly, technically here, you're absolutely right on the pattern. Big beat in economic data, dollar up, gold big time down, but gold doesn't see any follow through on those things. And that's been fascinating because usually you do see a little bit of follow through, at least from maybe not the immediate next day, but typically you do see follow through from a pattern and a trend perspective. We haven't seen that. We've seen support hold really, really firm. And, honestly, Mark, my read here is the intraday analysis is very strong based on algorithms, but anybody that is a real person isn't selling on that data.
Yeah, no, it's just, it's help when you understand. It's like the old NBC, the more you know. The more you know, it helps you make better decisions.
And the only thing I would say, and I think the only thing that is important to update, is if you do break 2,300, you should lock those risk reps down.
Yeah. So anyways, I just want to touch upon that. Listen, check out, hopefully you've enjoyed this podcast. Hopefully you enjoyed it. It's this, I enjoy it. It's been a lot of good calls we've had for a long time here. Talked about some more concepts here, but on Wednesday, it's all going to be about AI Gold Rush webinar. Be sure to attend. The link to find it will be there in the description on various different things we do. And if you're watching it on the YouTube, well, it's going to be on this same channel. It's going to be on this same channel. So just show up at the same place.
Yeah, Wednesday, 8:30 p.m. Eastern Standard Time, AI Gold Rush webinar. Obviously, we're going to have a lot of fun on Wednesday, so definitely come join us live. It's always enjoyable when we get a lot of participation in those live webinars on YouTube, and we absolutely love it when our pro members show up to our YouTube webinars. They don't need to. We have a lot of these conversations in a lot more detail, a lot more action instead of just awareness in our pro membership. So come join us as a pro member, and also join us on Wednesday, 8:30 p.m. Eastern Standard Time, June 26th, for the AI Gold Rush conversation that we're going to have. So be there. It's going to be fun. Going to have a lot of fun there. Also, if you're watching on YouTube, go ahead and like and share. Help us out with those Google algorithms. And if you're listening to us on a podcast near you, thank you so much for being the best part of our Trading Justice podcast and our tackle trading community at large. We love our community. We hope you guys enjoyed the podcast this week. And if you did, like and share that thing and help us get more viewership of the Trading Justice podcast as well there. With that said, everybody have a wonderful, wonderful week. And if you need anything from our sponsor, tackletrading.com, which is obviously us, you can hit us up at team@tackletrading.com. You can hit us up in our Tackle Trading Discord channel, or you can talk to us on any of the many webinars we do every single week at Tackle Trading. So when you're ready to become a pro member, head over to tackletrading.com, sign up for a free 15-day trial, and let the fun begin.
Listen, everyone, have a fantastic week, everyone.